Hi, this is Zach Meir with the Bulletin Board Heroes here at Vox Markets for Monday, the 1st of August. And starting off with the FTSE 100, with things are looking brighter than they have in quite some time. The reason for the enthusiasm, or the relative enthusiasm, is the way that we've got now the 50 and 200-day moving averages both rising. That means that implies they're heading for a golden cross, which could be in the next week or two. And the run-up to a golden cross is traditionally the strongest part of the cycle. We did have a warning, let's say, of potential bullishness ahead with the crossover of the 50-day moving average down below a rising 200-day line, which was in the early part of last month, and I suppose that was versus around the 7,200 level at the most. So that was actually a decent signal, but the run up to the Golden Cross, a decent sort of flag that we could be heading up to post February resistance around 76.50 over the next week or two, which sounds pretty punchy, but we've got the RSI at 62, which is still way off the overbought area, so things are shaping up quite nicely. I suppose they should really, with the multiple tests of that 2-year uptrend line we had for that 2-year price channel over the course of late June and early July. If you are an optimist, and there may be some still left out there, the top of the channel there is up to 8,100, so obviously that would be if we did actually fulfill the bullishness, it would be the target maybe for the end of September, something like that. And clearly, that would be a very big surprise for the pessimists who think that the cost of living crisis and inflation would kill the stock market. So let's see who wins on that scenario. At this stage, only well below the 50-day line, currently around. Let me just get that for you. Currently around the 7,300 level, really delays the upside scenario. So let's, as I said, see how this pans out. On to Bitcoin, which has been not quite so sprightly as the FTSE in the recent past. Here we've got a situation where we were hoping that this market would at least test old May support there around 25,400 as new resistance. Instead, what we've done, we've sort of double topped really near the 24,500 level. Still not time to give up on the recovery argument. While we're above the 50-day moving average, that's currently around 21,300. We could still get up to 25,400, i.e. to test that old support as new resistance. Nightmare scenario is a break actually back below 19,000, which is basically the late June, early July support for this market. But at the moment, while we're above the 50-day line, probably pays to be on the optimistic side. Moving along to the stocks, and covered AIQ yesterday on Sunday, and obviously we've seen a decent move here. We were just sort of perched and poised on that resistance line there before the weekend. That's a 1-year resistance line, and the call was that above that, on a mid-price close basis, we could head up to the top of the channel there, up to 30 pence. So I suppose the real sizzle on this is trying to work out where the top of the channel is, which it could be 30 pence, and looks like it could be that. While we're above 12 and a half, we would look for the upside. Anything below that, it's probably the end of the rally. On to Byotrol, which was a stock which had lots of high hopes over the course of the initial part of the pandemic, but it's taken a while to find its feet. Had that final bear trap there towards 2.37 pence at the end of June. We've got a couple of higher lows since then. What's good now is we've got the 50-day moving average already rising 3 solid days so far in a row, and if we can break through the 3.6 area, which is a 1-year resistance line, we can see the shares up to around 5.5 pence by the end of next month, which is post-November resistance. This stage only really back below the 50-day line at 2.68 pence, really delaying the upside scenario. On to Cellular Goods, which has not exactly been a party for investors over the last 8 months, 9 months, something like that. We peaked out around 11, 12 pence, and it's been very painful ever since. Current position is that we're waiting to see whether this market can actually break above the 50-day moving average. That's around 1.4 pence. If we can do that, then it could be back to 2 pence and post-June resistance. As the way things stand at the moment, probably we are reasonably confident that we'll get that break to the upside, given the way that the RSI is now pushed above neutral 50, and that's very often a leading indicator on a move to the upside. Only back below 1.15 or so, really delaying the upside scenario. Another very strong performance on the fundamental front from DeepVerge. So I think over £2 million in the kitty for modern water. And we've got this U-shaped bull flag. Looks like we should have at least 19 pence in the can here in terms of the target. That's the top of a broadening triangle from back in March. And I suppose if we can get that by the end of this week, which would also break through the 200-day moving average at 18.3 pence, we can start dreaming of up to the mid-20s by the end of next month. Remember, we've got an unfilled gap to the upside here after a bear trap. So bear trap gap reversal. We've got the bullish divergence as well with the lower June and July lows, but higher RSI trace. So it's everything really there at the moment. Looking well settled there for DeepVerge, both fundamentally and technically. Onto a stock which gets a periodic look here. It's Ilika. It looks a bit like the Byotrol chart here. So we've got the got bullish divergence. We've got bounce off that support line there from October. Bear trap as well from below the May support there around 55 pence. And it just looks like the shares are ready to break that line of resistance from December. That is running around let's call it 89 pence, and above that on an end of day close, we could be looking as high as £1.60, which is that December resistance line projection, maybe as soon as the end of next month. Stop loss ideally back below 74 pence, which is the neckline resistance since June for the shares. Onto a stock which is maybe looking interesting on both a fundamental and a technical point of view, from a technical and a fundamental point of view. Here we've got a situation where it looks as though the shares have found a line of support there from back in October, and if that holds and we have no fresh lows below the 50 pence area, we could see the shares rise up to fill that gap up there to 72 pence, which was left in this on the daily chart last month. Best case scenario above 50 pence up to 80 pence maybe by the end of next month, but I think that gap there could be a destination for Revolution bars over the near term. In terms of the overall configuration of this chart, probably say that we're in a falling trend channel from back in September last year. So that's the ultimate destination. If we have a full-blooded recovery, then we could end up at £1 to £1.05, but initially 72 while we're above 50. Moving along to Supply Me Capital, which seems to have revitalized itself, and always nice to see a stock or a market overrun overrun the highway there. So we had the target there towards 0.14. We've broken through that and above 0.14, and actually probably to be safe above the 200-day moving average at 0.12. We are looking at a best case scenario target here as high as 0.3 pence by the end of next month. So the 200-day line there, quite crucial. That area was the old resistance, post-March resistance, so it makes sense above 0.12. We could have further upside. Initially, obviously, we got the old December peak there at 0.23, but the bigger picture is up to 0.3. And maybe after all the weakness we've seen, it's time for the shares to overachieve rather than underachieve. On to a stock which is ready to go. Well, let's get the right one. I think we've got Union Jack Oil next, and here we can see that shares have punctured the 50-day moving average area very nicely. So that's around 25 pence, and it looks like we're heading towards the top of a rising trend channel from October as high as 38 pence, maybe as soon as the end of next month, while we hold above the 50-day moving average level. Just going on to Tirupati, which I was actually trying to get on the last stock. Here we've got a situation where it's just worth watching out now with the newest CFO and the downstream promise that the company has in the UK. That suggests that we're just waiting for an end-of-day close above the 50-day moving average, currently at 42 pence, to get us up towards the 50 pence area by the end of this month. Stop losses, I think I said yesterday and recently around the 35, 36 pence level, so maybe just below 35 the safest there at the moment. Finishing off with Wishbone, which seems very content about its drilling situation, and here we've also found support here with a rising support line there, uptrend line there from back in April. That's been very useful. It saved the shares at the beginning of last month, and it looks like it's done the same now as well. The view now is that while we're above the 50-day moving average of 11 pence, we've got the long-awaited move to 18 pence at the top of a rising one-year trend channel. That's it for me today. More updates tomorrow.